So now let's get to the three things that are bothering me about the market. And these are just in the back of my mind, troubling me. And what do I do with that information? It doesn't change how I execute, but it does change the amount of risk I'm willing to take. So I said to you all yesterday, risk monitor yellow today. And by the way, we should have started out with that conversation. It's risk monitor yellow. Yesterday, there's a reason we go from green to yellow. It's because the further away we get from the original risk on trigger, the higher the risk is. That could be in time or price. Either the assets have gone up a lot, so we're too far away from the stop, you can't add anymore, or it hasn't gone up enough and the time is starting to eat away at us. And we need a follow-through day to get this market to really go, or we have a problem. So, excuse me. So it doesn't usually happen that when we go from green to yellow, we get a day where the market gets pounded. But I find it, I kind of chuckled this morning because I'm like, this is the reason why we go risk monitor yellow. And I wrote to you guys yesterday, what that means for a conservative account is that when you hit a stop, you start building a cash position. And so here are the three things that bother me that are going to skew me more towards the conservative way of running money. Number one, the Fed said yesterday, I wrote this down for you guys so you can see it. The Fed said yesterday that they're looking to sell $13.7 billion in corporate debt and ETFs by the end of the year. The reason this bothers me is just from what's the word I'm looking for? I can't think about it, but it'll come to my mind. Maybe you guys will know what I'm trying to say. Symmetry. That's what it is. We got this unbelievably great risk on buy signal last year in late March, and we made a ton of money off of it. And the piece of news that triggered that was that the Fed was going to be buying an unlimited amount of corporate U.S. debt and corporate debt ETFs, LQD. Remember that? So the symmetry there concerns me. It's not something that you can put into an algorithm and trade. It's just in the back of my mind, when the Fed starts doing things that reduce liquidity, that's a problem for the market. I'm not going to exit everything. I don't exit everything, but it's in the back of my mind. So if we break up trends, we recognize there's a real problem here. It's not just a short-term wiggle. If the S&P breaks that uptrend, there's a reason. And it's because the Fed is starting to, even if they're not talking about tapering, they're actually doing some things that are reducing liquidity. When they sell their bonds, they're reducing liquidity. Between now and year end. When will the market start to discount that? I don't know. That bothers me, number one. Number two, IBD risk monitor. I call it the risk monitor. It's the ARMR Report risk monitor, red, yellow, green. Investors Business Daily, which is William O'Neill style of investing, which is really the cornerstone of my entire process. I got into the business over 30 years ago. My dad used to take me to, this is over 30 years ago, where there were not computers. I could not have this conversation with you online like this. When I say they're not computers, that none of the O'Neill stuff was on computers. We literally got in the mail once a week chart books, and we had to go through the chart books, which was so much fun. I gotta be honest with you, flipping, looking for patterns, drawing patterns, tearing out sheets, putting it up on the wall. I mean, okay. So I respect William O'Neill. And I say this in all humility, I've taken core of what he does, and I've adjusted it for what I think is right for the market we live in today to be more effective. But I follow it. I read the IBD, and I find it comforting when I see the IBD risk monitor go from a market that's under pressure to a bull market. They change colors too. Actually, they go from yellow market under pressure to green, bull market. And I love confluence, you know that. So when we have ARMR Risk Monitor goes green and we start making money, we are. And IBD is still telling us the uptrend's under pressure. That concerns me. So every day I keep checking it, waiting for them to say, oh, bull market, no longer under pressure. And that would confirm, that would give confluence to the ARMR entry point. So now we've already made money. So O'Neill's late, right? Because we're making money. But if this whole thing implodes, they won't be late, right? We'll end up giving back a lot of what we've made. We'll go back to cash. Maybe depending on how fast we can get out, we'll have a bit of a bump to our net worth. It depends. But I don't like that. I really thought that by now the O'Neill risk monitor would be green with us, and it's not. So that's a problem. And the third thing, and probably the most important here, is meme stocks. Okay. The meme stocks are going berserk. And while I'm happy for Pac and all you guys that are trading these meme stocks, it's terrible for the market. It's terrible. And I think Spot Gamma did a good piece on this today. They show a chart. I'm going to show it to you right here. The last time, which was January 25th, when we had this massive spike up in, I think it was GameStop, right? GME, because the memes were going crazy and everyone was having fun. Melvin Capital blew up and the S&P imploded. Now, it lasted only for a short period of time, but it ripped us out of a whole bunch of positions because a whole bunch of stops got hit. Okay? And the third thing, and probably the most important here, is meme stocks. Okay? The meme stocks are going berserk. And while I'm happy for Pac and all you guys that are trading these meme stocks, it's terrible for the market. It's terrible. And I think Spot Gamma did a good piece on this today. They show a chart. I'm going to show it to you right here. The last time, which was January 25th, when we had this massive spike up in, I think it was GameStop, right? GME, because the memes were going crazy and everyone was having fun. Melvin Capital blew up and the S&P imploded. Now, it lasted only for a short period of time, but it ripped us out of a whole bunch of positions because a whole bunch of stops got hit. Okay? So it's terrible when those stocks go up 100% in a day. It's not normal. It's fun. It might be fun for you guys, but it's not fun for a real portfolio, for a real investor. It just gums up the works. Because eventually someone blows up, like a hedge fund, although I can't imagine who is the idiot that's still short these things. It creates margin calls. It changes the way all of a sudden Robinhood can't trade things. Like there's a ripple effect to all of this. While it's fun to make a little bit of money in your account, it's ruining a system. And it creates gap downs. And we find out later why. Either there's a problem at Robinhood or a hedge fund's blown up or whatever. And it just gets in the way of a nice risk on green signal. It forces us back to cash. This has been the year. So it's been a year of that. I don't like it. And this, just to round it out, is what the management of AMC said. They literally put out a release today, an 8K, and they say, we caution you against investing in our stock unless you're prepared to lose a part or all of the investment. And the management went on to say that the stock price is completely, and I'm paraphrasing now, completely devoid of any reality when it comes to the economics of their business. So those three things together make me very concerned. How does it affect my my management of money? It doesn't. in this from the standpoint of I don't go sell everything because I'm concerned, but it does temper my enthusiasm. When I begin to get stopped out of things, I am going to build a cash position.